There's a recipe to everything: cookies, pasta, or even a stock market crash in 2020. In order for this to happen, all the ingredients have to be there. And believe it or not, many of the critical ones are already in place. We'll go over 3 of them in this video. Number 1, the Black Swan. Number 2, inverted yield curve. Number 3, complacency. Welcome to Money Insiders. My one and only goal is to increase your financial literacy by 1% every video. If you're new to this channel, do consider subscribing and dropping a like to show some support. Number 1, the Black Swan, as known as the coronavirus. This plague has been with us for the past 2 months, and is certainly the biggest black swan so far this year. We have no idea how these swans were born, how many there are, and how fast it can fly. With China locking down all the critical information of the virus and feeding us numbers that are easily negligible, this swan certainly has some stealthy characteristics. Right here we have some screenshots I took from the Tencent news app over the past 4 weeks. We'll mainly look at the numbers that matters most. The black cells representing the number of deaths, and the red cells representing the number of confirmed cases in China. If we divided these 2 numbers for each of the 4 dates, we have February 1st at 2.1%, February 8th at 2.08%, February 16th at 2.68%, February 23rd at 3.17%. They have carefully contained the numbers to be within 2 to 3% in order to not raise any red flags and shock the world. For this February 16th photo, it doesn't even show reference numbers from the previous day. How careless, right? On January 23rd, China locked down Wuhan when the known cases were claimed to be under 10,000. Wuhan's population is 11 million. 10,000 into 11 million is 0.09%, and the death rate was claimed to be 2% of that, 0.0018%, much less than a common flu. Would any country in the right mind lock down their international business hub if the infected numbers are so low? I'll pull out the Tencent news app for you on the screen. It loads for a split second and the report shows up in the middle here. I'll click in, loads a little bit, then shows the various metrics, how the virus looks to be tapering off, the regions that are infected, etc, etc. I come back out of the app, refresh, and everything is gone. Doesn't matter how many times I refresh, I just can't find it, until I shut down and reopen the app. Shouldn't this epidemic be the number 1 concern for a country of 1.4 billion people? On February 2nd, China injected $174 billion of liquidity into their market. Along with their policy prohibiting anyone against short selling, this is how the Shanghai Composite Index performed for the past 3 weeks. The manipulated market is utterly ridiculous. Rising 13 of 15 sessions, rocketing up 10+% in the middle of an epidemic. And here are 3 daily charts that shows the apparent government support for the market. All of them had an obvious V bounce to keep the market on this uptrend. Looks kinda like a pawn game, right? As of last week, President Xi continues to push the workforce back to the factories in order to sustain the country's economic growth. Just how many workers are willing to go back full force with the lurking virus around every corner? I think the lives and health of the families may take precedence in this case. With China's manufacturing crippled for the next little while, how will the global economy fare in 2020? Businesses that rely on selling imported China goods would take a huge hit. Apple already came out and said they'll miss the revenue forecast for the March quarter. Car manufacturers are no exception, since China plays a large part of the supply chain. Restaurants are tanking because nobody wants to be in crowded enclosed space. Many retailers have shut down the stores in China, including Starbucks, McDonald's, Apple, Lululemon, and more. China has used many tactics to hide this black swan. And they even tried to disguise it green with a $174 billion stimulus. This swan seems to be taking flight in the recent days, hitting Korea, Japan, Israel, Italy. And the most alarming thing is that a lot of countries aren't even equipped to distinguish between the common flu or the coronavirus. With a potential plunge of company profits, it could mean layoffs, which means less spending for the economy as a whole, and the cycle continues. And that's the exact definition of a recession, a period when the economy of a country is not successful and the conditions for businesses are bad. Number 2. Inverted yield curve. We keep hearing this technical term associated with recessions. To keep it simple, the yield curve inverts when the yield of a long-term bond is lower than the yield of a short-term bond. This just shows that many money managers and retail investors are loading up on long-term bonds since they're concerned for the economy in the short term. In turbulent times, experienced investors tend to park the money into assets that are less correlated to the stock market, because stocks are considered a more risky investment vehicle. As of today, the US dollar is at a 3-year high, and gold is at a 7-year high. Even virtual gold, Bitcoin, has gone up 30% in 2020. Since 1950, the yield curve inversion has come before every US recession. But not every instance of an inversion was followed by a recession. As shown by the JP Morgan graph, this signal has been right 7 out of 10 times. The gray vertical bars representing recessions. Anytime the graph dips below the 0% line, means the yield curve is inverted. We'll look closer at the 2 recent cases. The 2001 dot-com bubble. It was in the inverted portion for 6 months, between July 2000 and January 2001. Then the recession happened 8 months later. The 2008 financial crisis. It was in the inverted portion for 13 months, between July 2006 to August 2007. Then the recession happened 18 months later. For this hypothetical 2020 crisis, it was in the inverted portion for 4.5 months, between May 2019 to October 2019. Then the recession will happen X months later. Comment down below what you think the number X is. It's obvious there's a bubble, and just as likely it will pop. But when? Number 3. Complacency. The market has been on a tear. It's the longest bull run ever at 11 years and counting. Looking at the Dow Jones chart, we ran from 6,500 in February 2009 all the way to 2956 in February 2020. Dividing the two gives us a whopping 455%, more than 40% per year. In recent years, many have taken advice from Warren Buffett and bought dividend stocks and low-fee index funds for passive investing. The winning strategy is just keep buying when there are any dips, since the market is always going to be up in the long run. But what happens when this strategy comes to a crash? The market's default motion is known to be volatile. As Warren Buffett stated in his annual letter last week, occasionally there will be major drops in the market, perhaps of 50% magnitude or even greater. We need to understand that if a $100 stock drops 50% to $50, the climb back up requires twice the effort. At 100%, for $50 to go back up to $100. Historically, the US market is said to average 7 to 10% per year annually. It has been doing 40+% for the past 11 years. Will the scale start to balance anytime soon? These are the 3 ingredients I believe could trigger a 2020 recession. There may be many more that are required before the perfect crash. So what do you think? Have I increased your financial literacy by 1%? If yes, then consider subscribing, hitting the bell, and dropping a like. Otherwise, you can comment and let me know how I can create more value for you. Take care and have a good one. Check out these video links if you want to learn more about different investing strategies.